I'm Jennifer Siegel with Derivative Logic. Today, we're going to talk about interest rate swaps. We'll cover topics such as what is an interest rate swap, when would a borrower use an interest rate swap, and how are they priced. Swaps can seem like an intimidating topic, but we're going to put that notion to rest. In this video, we are going to talk about over-the-counter swaps. These are customized contracts agreed upon between two different counterparties. You may not realize it, but interest rate swaps are widely used financial instruments. The US dollar swap market is one of the most liquid markets in the world, with trillions of dollars traded each day. So what is an interest rate swap? An interest rate swap is a financial contract where two parties agree to exchange or swap interest rate payments on a specified notional amount for a certain period. The notional amount is the principal amount used to calculate the interest payments. This figure is not exchanged between the parties. It's just a reference for the interest calculation. The defined period is the length of the swap contract. For example, that might be the term of the borrower's underlying debt. The purpose of the swap transaction is typically to manage interest rate risk, and it involves two different types of interest payments. One party pays a fixed interest rate, and the other party pays a floating or variable rate. Here, we will look at an example scenario where a business wants to protect against adverse movements in interest rates. Specifically, we will assume a borrower has a floating rate loan and would like to fix that variable rate of interest with a swap. They want to swap their floating rate interest payments for a payment based on a fixed rate. Let's assume we have a commercial real estate investor who has secured a floating rate loan to purchase a building. The bank has offered this company a $20 million 5-year loan priced at 1 month SOFR plus 4%. Over the life of this loan, 1 month SOFR will reset every month to a different rate. The borrower does not like the uncertainty and risk of not knowing how much interest will be owed each month. The borrower would much rather have a fixed rate, but the bank does not offer fixed rate loans on this type of financing. What can our real estate investor do? They can enter into an interest rate swap with a swap counterparty where the two parties agree to exchange interest payments. The investor or borrower will now pay a fixed rate, and the swap counterparty will pay the investor a floating rate. The swap is an additional contract that does not alter the underlying debt facility. In the swap, Party A, the real estate investor, agrees to pay Party B, the swap bank, a fixed rate based on the 5-year SOFR swap rate. In our example, we'll assume this rate is 3.5%. Party B agrees to pay Party A the floating rate of 1 month SOFR. How does this create a fixed rate? Party A receives 1 month SOFR in the swap, and at the same time, it owes a payment based on 1 month SOFR to the lender. Those two cash flows will cancel each other out. No matter what number SOFR may be, 1%, 10%, the investor will receive an interest payment based on that SOFR rate under the swap contract. That exact same amount will be owed on the floating rate loan. The investor can simply pass those funds onto the bank to pay the loan interest. The investor is still responsible for the bank credit spread of 4%. The all-in fixed rate created by the swap is 3.5% plus 4% equals 7.5%. Through the interest rate swap, the investor now has a synthetic fixed rate loan. The debt cost is now locked in at 7.5%, providing the comfort of knowing the exact interest cost that will be owed. How does the swap bank come up with the swap rate they agree to pay every month? The fixed rate is calculated using the SOFR forward curve. The forward curve is the market's projection of where SOFR will reset over time based on SOFR's futures contracts, which are traded in a futures exchange. This is the 1 month SOFR forward curve for the next 5 years. The fixed swap rate is simply the average of those forward points over the 5-year term. Knowing that swaps are priced based on SOFR, some borrowers get fixated on watching SOFR move up or down by a few basis points. We actually don't care what 1 month SOFR does. This is because different factors affect longer term rates versus short-term rates. The longer-term swap rate will move based on those factors, such as expectations around future interest rates, inflation, economic conditions, etc. In our previous example, the interest rate swap had the same dollar amount and tenor as the underlying loan. However, swaps are very flexible and can have terms that are different from the debt they're hedging. For example, if our borrower has a 5-year loan but is planning to sell the underlying asset in 3 years, they may want to execute a 3-year swap to give them flexibility. Using a swap that more closely matches the expected loan term allows a borrower to avoid the prepayment amount they might owe if the swap is canceled before the maturity date. A swap will have a prepayment amount calculated if a borrower wants to cancel it before the maturity date. The amount is based on current market swap rates. So a borrower could actually receive money from the bank in certain circumstances. Specifically, if a borrower wants to cancel a swap before the maturity date and the replacement swap rate is higher than the locked-in swap rate, the bank will pay the borrower that difference. If the market rate is lower than the locked-in swap rate, the borrower will have to pay the bank the difference in rate. Fixing rates for a 3-year term when the borrower expects to sell the property in 3 years will eliminate any prepayment risk, unless, of course, the property is sold even before the 3-year maturity date of the swap. If the loan is still outstanding after 3 years, the interest rate will just revert to floating 1-month SOFR. If a borrower wanted to cancel a fixed-rate loan before the maturity date, there's also a prepayment penalty attached, although there's no scenario where a borrower would receive any money back from the bank. Other flexible swap strategies include only hedging a portion of the outstanding dollar amount or executing a forward starting swap where the rate is locked today, but the swap begins at a future point in time. I mentioned earlier a swap is a separate contract. It actually has 2 separate parts: the International Swaps and Derivatives Association Agreement, or the ISDA, and the confirmation. The ISDA is a standardized agreement that governs a swap transaction between 2 counterparties. It's divided into 2 sections. The first section is called the ISDA Master, which lays out the basic framework and provides definitions. The second section is the ISDA Schedule. This part customizes certain terms and conditions to the underlying loan structure. Then there's the confirmation. This document includes the exact terms and conditions of the interest rate swap itself. For example, the trade date, the notional amount, the fixed swap rate, payment dates, etc. To conclude, interest rate swaps are widely used by corporations, financial institutions, and even governments as a way to manage interest rate exposure and stabilize cash flows. Many businesses do not have someone on staff who's an expert in derivative products or own an expensive pricing system to provide transparency. That is where we at Derivative Logic come in. We are independent risk management advisors and educators with extensive experience in capital markets. It is never too early to get us involved to help you evaluate and structure your next deal.
Derivative Logic, calming complexity.